So you guys have two options now. Okay, great. I'm gonna go ahead and get this show on the road. Today's trade alert is now I did change the format of the trade alert. So let's just look at that really quickly. We'll just go through the trade alert head to toe to get started. Then I'll do more of an overview for new folks so you understand how our program works in detail. And then we can look at also the top news, which is really this China deal. The whole market's betting big that trade deal will happen, or at least let's see, we do have a live chat popping up here. Okay, Ulet's been trying to paper trade. Some things don't understand. Great. Well, that's a great opportunity to ask your questions. I'm sure a lot of people have the same questions. Okay, so let's start off with just looking at today's trade alert, get everybody understanding the thinking behind our current position. Then we'll take a look at the topical data that hit in the last 12 hours, which is affecting our stance. And then we'll go through our, actually part of our $10,000 boot camp, which really gives you the big picture as to why the SPY TLT strategy works so well. When you're not trying to beat the market, you're actually just trying to never lose money, or at least very much at any given time. Okay, guys, so current trade alert, and I did alter this if you've been following for a while. We previously had buried the trade alert like 10 pages below, making you look at the track record and all this jazz. And so we've switched it up. I got the trade alert at the top. And so if you're just getting started with the program, the trade alert is per 100 shares of the SPY to sell to open the 316 SPY call option and to buy to open the 314.50 put with the expiration of 12/9/2019. That's from today through Monday. So this trade is geared to generate income safely between now and Monday. So what could possibly go wrong over the weekend? We'll take a look at that in a minute, plenty. The trade is extremely safe. And in this setup, which you can see in the risk graph, the most we stand to make going into this trade alert is $76 per. Okay, Ulet is having questions on how and when to sell. Okay, great question. So the bottom line is we're only going to touch these trades at the exact same time on the exact same dates, and we're all doing it together. There is absolutely no exception to this rule. And so right now is when our entire audience has been putting this trade on. So people like Murray, who've been following the program for better part of, I think, 6 months now, they've probably already put the trade on. The good news is the trade is good for the end of the day, and it's not a huge urgency. Let's take a look at today's trade. Step one is you have to have 100 shares of the SPY ETF. That puts you in the place of being the landlord who has the ability to rent out his property for income. So that's the whole basis of our program. Now, depending on how risky the market is and what lies ahead in terms of catalysts, we also buy downside protection. So in this setup, we've sold a call option for income, and we've turned around and purchased a put option for protection. And so if you guys have been following me, I was calling for 315 with a phase one trade deal hope. And if we actually get a phase one trade deal, I think we can go substantially higher. Probably 330 to 360 would be the new range that I would look for the SPY to travel to into next year, if we really are able to close a phase one trade deal. And then we got to worry about phase two. So the China story doesn't end there. So what's the whole point of this trade and how does it work? In this trade setup, we actually need the SPY to travel higher to generate a profit. The trade from Wednesday, we only needed the SPY to trade flat. And so the big news today was just a huge number of jobs added in November, a big boost in the manufacturing sector, and a whole lot of waiters and waitresses and services jobs have been added. So this sent the SPY rocketing higher. We missed out on the bulk of the run up today. And that's because we're much more concerned about what lies ahead. And there's several big catalysts happening in December that makes sense to play it safe. And so you can see in the trade alert document, we've been racking up a whole lot of profits on the SPY ETF. My expectation now is that there will be some volatility to close out the year. So I'm trying to make sure we don't lose all the profits we've racked up on the SPY and capture a big profit on the TLT and GDX to close out the year. So we'll take a look. I also want to point out, it's very rarely that we will generate a profit on the SPY, the TLT, and GDX at the exact same time. It's typically one goes up while the other goes down. We try to lock in those profits and then catch a big win on the other half of the trade. So for those of you who've been watching the TLT bounce around, I'm still very bullish on that. We'll take a good look at that. So in this setup, it's a little bit more bullish than we had on Wednesday. So on Wednesday, we had sold an at the money call option, and we only needed the SPY to go flat to generate a profit. In this trade setup, we've actually went and sold the 316 call, and we've purchased the 314.50 put. So we're short the call and we're long the put. Both of these options are bearish. So if we're correct and the SPY does travel up, expect to see a loss on the options and to generate the profit from the SPY traveling higher. So I just want to make that crystal clear for everybody who is putting on this trade. So that's the current trade setup. Here's the results of our previous trade. And again, if you're just starting out, first step is to buy to close the SPY call, sell to close the put. However, if it's only worth a penny, you have to allow it to expire worthless. Now, that's never true for your short call. You'll always have to buy back your short call, even if it's only worth a penny. But on the other hand, the put option, no one will purchase a put option that's expiring that day for a penny. So just allow it to expire worthless. And so let's review the results of the previous trade. So unfortunately, we missed out on a good 350 of the move up today. So the SPY traded from 311.70 when we put on the trade and traveled to 315 when I closed out the trade today. We were short the 311.50 call and we were long the 310 put, expiring December 6th. When we put on that option caller, we actually took in a big credit of 68 cents. And that's after we bought downside protection. Now, again, this program is not about trying to outperform the SPY. It's more about trying to avoid loss and generate safe income with extremely low volatility. And when I show you our track record, you'll see we've done just that for clients for the last 12 months. So to close out today's trade, we had to give back $3.50 of the profit that we could have had if we were just long the SPY. Our net profit was 45 cents a share and brought in a total profit of $855 in our portfolio, which is trading 19 contracts of the SPY ETF. Okay, so that's the current trade alert. Let's look at the rest of the trade alert now. So I have a big list of the trades we've put on since the phase one trade deal came out. And if you follow my daily video, I really don't believe we're going to get a phase one deal. And the market's priced not only that we get a phase one deal, but also that the global slowdown really turns around and starts to go back to 2% plus GDP growth in Q1 of next year, which are some pretty big assumptions by the market at this point. But because we're in quantitative easing land, the banks just were able to cash out billions of profits on their bond position, and they have free ammunition. Okay, so let's take a look. Our emerging markets position was put on Tuesday. Now remember, on Tuesday morning, we woke up to a tweet or at least a mention of what Trump had done in London, saying that maybe we're not going to do a trade deal till after the election. This sent the market screaming lower. And so the best information we had at this time was that the trade war was in a period of escalating. So we did put on what we call the inverted option on emerging markets. And so this trade will profit if emerging markets travels lower. So again, this trade is down 20 cents currently. And you can see this is updated daily for you in every single update. So we make sure our members know exactly what's going on in all positions at all times. This makes your life a lot easier. Now the TLT, surprisingly, is holding up quite remarkably. Typically, if you have a blockbuster jobs report, you can see yields start to spike on the bond market. And today it really didn't. So this is only down 33 cents. TLT and GDX, you should expect to slow bleed until something bad happens, and then they pop much higher. So it forces us to trade these assets a little bit differently than we do the SPY. The SPY we're trading every 48 hours, so we can lock in what I call just some easy hits left and right, very, very, very frequently with a high win rate. The TLT and GDX are going to behave much more differently. They will go flat or slow bleed until something puts panic in the market, and then they jump much higher. So we have to be patient to capture those gains. When we do look at the profit loss on the bond market and GDX, you'll see why it's so important to our strategy. GDX is down 21 cents a share after calculating everything. And so let's take a look at our monthly return now. Okay, so our year-to-date return thus far is 13.15% 2019. And when our service began in December, we had a 1.2% return. Our total return in the past 12 months is 14.6%. And I do want to point out that our biggest drawdown over the entire stretch in a month is -1%. So the S&P 500, if you had magically bought on Christmas Day at the very bottom of 2018 and held through all the volatility, is up 26%. And it's done that with some pretty severe volatility. Now, if you go back to the high of October in 2018, the return of the S&P 500 is barely up, and you had to suffer through 20% plus volatility. So what I like to do is compare the returns of the SPY against the risk it gave you, and then look at our return against the risk we've gave our investors. So with the S&P 500, you're looking at least a 1-to-1 ratio of risk to reward in the last 12 months. So you're risking $1 to make $1 and having to hang on to some pretty massive swings to the downside. Now, for now, it's rebounded, so investors aren't too worried about that. But what about when it doesn't rebound? So when we go through our presentation, you'll see why we are coming to the end of the rope for what the Fed can do to keep this bubble and this business cycle expanding. In our portfolio, we've essentially delivered a risk of $1 to return $14.6. So if you look at every hedge fund that's become top shelf, we're talking Ray Dalio, Jeffrey Gundlach, their big thing is that they can deliver return with less risk. So that's our goal in this program. We're absolutely not trying to outperform the S&P 500, and we're not trying to hold on to big losses in hopes that it will rebound and recover to a new high. So that's a big difference. If we scroll a little bit lower in your daily update, you can now see the breakdown, and you'll see each different portfolio has periods of winning and periods of losing. It's when we overlap all the strategies together that we're able to get such a clean return over the course of time. So here's the SPY ETF up 11.6% so far today, or this year. Now in this chart, you can see our palette. We're going to be in the SPY ETF for most likely 2 to 4 years before I would suspect we've had a major reset. We might rotate into some of these other ETFs that are a little more risky. But realizing we're at the top of a bubble, we want to do the safest assets. The SPY ETF gives us 3 option expirations a week, which makes it much safer to trade with the ability to follow the market and move our put option right underneath the SPY at all times. And so we've seen countless times this year in the last 12 months where the SPY gaps down $5, $10, $20. And so those put options really kick in when the time comes. Emerging markets, we trade on Tuesday, has a much smaller allocation in our total portfolio and has a year-to-date return of 17.8%, but it did come at a cost. So you can see this smaller part of our portfolio has had greater volatility, the biggest loss in September and December, but it's been able to outperform the SPY in January and June, as well as October. Now, once again, we're at the very top of a bubble, nearing the end of a business cycle. So right now I prefer to own emerging markets ETF, which is a basket of 1,000 stocks, highly diversified, very liquid, and more importantly, it has a very active options market. So it allows us to apply extreme safety on this asset. The bond portfolio had been a blockbuster for us every single time the SPY has tanked. So if you want to know our magic sauce to have such a clean return, it is by holding on to the bond portfolio, which is the TLT ETF. Now, again, after rates spike higher and we've had a reset in these bubbles, we do have some other assets we could rotate into, but I would suspect we're a couple years out before that time would come. So I do want you to realize right now we're just playing the safest assets possible, trying to protect our capital and make some safe profits, because I do believe that 2019, where a monkey could have thrown an arrow at a board to make money with just about any asset. I mean, stocks are up, gold's up, oil's up, bonds are up. Doesn't even matter what you purchased. I don't think it'll be this easy to generate profits for much longer. And we'll take a look at the catalysts heading our way that are going to make this much more difficult. Precious metals and a small position in crypto. This position has grown as the Federal Reserve went from being hawkish last year, doing quantitative tightening and reducing its balance sheet to find out that would crash the stock market by the year end, with yield on bonds rising above 3% on the 10-year. In October, we saw exactly what happens. The second the bond yield becomes too attractive above the expected inflation rate, the banks ditch stocks for a guaranteed profit on bonds. So we have been growing this position size over the course of the year as the Fed has now officially increased its balance sheet to reduce every last penny that they tried to reduce in 2018. And we've had more quantitative easing in the last 3 months than we've ever had in history. Now, if you keep scrolling in the trailer, you can see our returns on top of the S&P 500. And again, you're going to expect this program to do very well in a downturn in equities, but to underperform equities when it's moving higher. And that's just the nature of our strategy and how we're able to protect capital and have such a low drawdown at all times. So in this example, you can see in May, picked up a 2.2% return when the S&P 500 crashed 7.5%. In December, you held on to an 18% crash, and we generated a 1% return, 1.2. Now, the last few months, we've been playing it very safe because I fear the trade deal, this phase one trade deal, is on the verge of being unhinged, which means we want to have exposure to the TLT. And until this event happens, it's been causing our portfolio to have a little drawdown on the TLT while we're slowly racking up wins on the SPY. My expectation to close out the year again is that we will see a nice boost in the TLT and a sell-off in the SPY as the trade deal fails to come to agreement. And that timeline is coming up. December 15th is when the tariffs are set to be raised currently. Now, once you get to the very bottom of the trade alert, we simply have a screenshot of how to enter and exit the trade alerts. So if you take the previous trade, you'll always want to look at step 1 for how to fill out your ticket in order to get out of the position. But if you're just brand new to the program, you would just start out at step 2. Now, for Yulette trying to paper trade this, here's really the secret for how to accurately audit the returns for yourself. But I think after you've watched this every day and joined us live, you'll feel comfortable that my accounting is extremely accurate and that your accounting will be within pennies of mine. Okay, so step 1 is you want to check out the last trading price when you enter the trade. So in this example, 314.97. And then you're going to want to keep track of what the option caller cost you. So in this case, we're paying 28 cents to put on this option caller. So then when we close out the trade Monday, we're just going to want to track 2 things. What's the new price of the SPY? So we want to see if we made money or lost money on the underlying asset. And then we're going to see what it costs to close out the option caller. So we'll see if we made a profit or loss on that. And so that's the way you can do your audit or paper trade this alongside our program. Okay, so let's see if we have any questions about that before we jump into some more topical news. And we do have some new people in here, which I do want to say hello. Ash Khan, welcome to the webinar. If you have a microphone, would love to hear from you. Let me go ahead and unmute everyone and see if we have questions before I move forward. Murray, William, any questions?
Not now.
The put, buying the put right now says it's 51 cents. So and you paid 58. Does that make a difference?
No, you're good. So the exact cost of the call and put will wiggle a little bit, but realize that means you're going to have either a better or worse deal on where your profit and loss lies.
Okay.
So yeah, the trade is still good, and
so
that's a
initially,
common question for sure is whether or not
as a buy a covered call and then in a separate trade buy the put.
You know what? Actually, you could do it in one trade. Let me show you. Now, also not on this boot camp, but the next boot camp. So the boot camp coming up Tuesday, we're going to learn how to use Forex to short the Hong Kong dollar. The following module is all about how to place these option trades using Ameritrade's handy phone app, which makes this really, really fast. Now, what platform are you guys? I know Murray's at Schwab. Where are you at, William?
I'm on Thinkorswim.
Oh, you're using the fancy system. Okay. So yeah, you're going to want to do a multi-leg trade, and you can place it at one time if you like, or you could do it separately. It's totally fine. And now that we got free trades, you know, you can ring those trades up as much as you like. Yulette, please repeat your question. Sorry.
No, I said we don't get free trades in Canada.
Oh, no.
No.
Well, you better do the multi-leg trade so you don't pay twice. Although the cost of the trades is relatively small. So what are you paying per option trade, Yulette? Or which broker are you with?
Toss.
With who?
Toss.
Toss. Okay, I've never heard of them. Are they pretty big in Canada?
No, Thinkorswim. Thinkorswim.
Oh, Thinkorswim. Sorry. Okay, sorry. Okay, so great. So any questions on how to place the trade, how to get in and out?
Nope.
Okay, great. Well, all right, let's move along. What I'd like to do now is look at the topical news, and then we'll jump into a more general overview of the program, how it works, and why it works, okay? Okay, so the big news that shot the SPY up to 315. Now, I know I've been saying I thought 315 was the top for the year. I think there's a chance without any bad news over the weekend that we can go above 316. We'll take a look at why. The big picture is that the banks just got bailed out to the tune of $320 billion. So they've got a lot of funny money from the Fed right now. And we have both the bond market and the stock market claiming they're right at the same time. So let's just look at what's going on. All right, so US added 266,000 jobs in November, and the market loved it this morning. It gapped open. So day traders have been missing out on most of the moves on the SPY. Most of the moves we have seen on the SPY have been big gaps, jumping the market open, which is done by using the futures market to bid it higher right before the market opens. And so typically that's not a very healthy price discovery. And you will find that over time, the markets like to come back and through the trading day, trade through every single price point. So I do suspect there's a high risk just from that price discovery right now, is that we've really gapped so fast to get to these levels. It's also been done on extremely low liquidity. So we're seeing summertime trading volumes taking us to new highs, which is also not necessarily healthy. Okay, so there's the first news clip. Here's the next news clip. The market is currently pricing in a phase one trade deal. The phase one trade deal is not accomplished. Markets headed lower, certainly. And so my concern is that it would get to this level with the hopes of the trade deal. The deadline's on the 15th. What could happen? Maybe Trump says, all right, they're talking. We're going to go ahead and delay this into January. So that's one outcome. Another outcome is Trump says, hey, these guys just won't do a deal. We're going to increase the tariffs today. And if they don't do a deal within a month, we're going to increase them even further. Okay, and we have seen that is Trump's pretty much go-to strategy when he doesn't get what he wants. And this is probably the fourth time the Chinese have said that they'll purchase agricultural products. So it really looks like they're just trying to drag this out as long as they can and have very little intention of actually creating a trade deal with Trump. So here's from the Yuan talks. U.S. President Trump is asking China to buy $40 to $50 billion of farm goods a year, significantly higher than the $8.6 billion purchased last year. U.S. also demands China publicly announce its purchasing plans and say they wouldn't depend on market conditions or China's trade obligations. So China doesn't want to commit to anything. They just want to roll back the tariffs and start showing good faith by making agricultural products. This is one of the communist leaders in China. A small number of political elites in the U.S. have extensively influenced the American society with their extreme thought on China. If China and the U.S. can't reach a trade deal. Sorry
Thank you
about
for
that.
calling Portfolio Builder. This is Dean. How can I help you today?
A small number of political elites of the U.S. have extensively influenced American society with their extreme thought on China. If China and the U.S. can't reach a trade deal eventually, and China-U.S. ties worsen further, these people must bear historic responsibility. And this is all coming out in the last 12 hours. U.S.-China leads the race to patent innovations on genes. So we can see China essentially has certainly stolen the golden goose. They're not just stealing now, they are innovating. Their children are coming out, and you know, whether you trust or not, their children are supposedly 3 to 4 years ahead of Americans in math and reading, along with Singaporeans. So the big picture is China is on track to become just as powerful as the United States over in Asia, and the hawks in the US do not like it. Meanwhile, China corporate bonds defaults climb towards all-time high. So divide that by 7 and you get a figure of what that figure looks like. A lot of these bonds are coming due, so they need to roll over the debt. China's corporations have $4 trillion in US denominated debt. So they have a huge demand to pay the interest of that in dollars. So if you are on the boot camp program, that fact alone is one reason why we do want to short the Chinese currency. So this is still a relatively small amount of defaults compared to 4 trillion, which would be 2,800 billion yuan. So they're defaulting on a small amount of it, but we've also seen something like 4 medium-sized banks in China fail. And instead of trying to keep it secret, China publicly let that occur. And we've seen a lot of photos of people running to their bank to try to get their money out of the bank in China. So China is certainly having some trouble, primarily with construction companies who have been over leveraged into building ghost cities and ghost towns. Okay, China will likely see this is from Bloomberg. China will likely see a record volume of corporate bond defaults this year. The question is if that's good or bad thing. For context, the first default in China's onshore bond market didn't happen until 2014. And even this year at more than 17.1 billion, they remain just a small sliver of the country's 4.4 trillion market for corporate notes. A phase 1 trade deal between the US and China looks increasingly likely if you ignore President Donald Trump, factor him in, and things get noticeably murkier. Really, Lighthizer your hawk on the US trade side. And I don't think that we have a trade deal. We'll take a look. US Treasury Secretary Mnuchin said Thursday that Trump administration opposes the World Bank's latest plan for low interest loans to China. US National Security Advisor, we're close on a phase 1 trade deal with China. US trade with China extended its slide in October as imports from the nation fell to a fresh 3-year low. Merchandise imports declined 4.8% from the prior month to 35.3 billion. Now I have some charts on this. It's not necessarily that China is trying to stiff arm the United States right now. The big picture is that China's GDP is crashing ever since 2010, when it became obvious that their method for generating really fake levels of GDP growth were all based on just flipping real estate within its own economy with no free market, with no ability for any property ever to show a loss. And now your average Chinese person owns not one house, not 2 houses, but 3. And the extra 2 houses they own, they're not renting, they're not even completed. They're just concrete shells. And so that's how they've kept this bubble economy going. The same thing happened in Japan. Okay, China, US remain at odds over the value of farm goods Beijing is willing to buy. Here's a look at US imports of goods. US imports from China slowing down, US imports from Mexico slowing down. Mnuchin not willing to comment on whether he would recommend Trump support the Uyghur Act, which would sanction Chinese officials for abuses in Xinjiang. So the storyline behind this is China is way ahead in facial recognition. They have, I think, 1 camera for every 2 people. So they have several 100 million cameras installed in China that sit there and they can scan thousands of people in a crowd. They've identified a race that's known for rebelling against the Communist Party. And they've been rounding up these people to the tune of millions. And it's scary. The software scans the faces, identifies who they are, what race they are, and prints out lists of tens of thousands of people to round up and put into these, what they call education camps. So if China does not do a trade deal very soon, this is going to become mainstream media right here. And it's already starting to slowly become that. We've seen Pompeo and Pence do some pretty harsh speeches just in the last 30 days specifically about this. And we're also seeing the Congress start passing bills whether Trump likes it or not. So the pressure is mounting. Mnuchin says China talks, we're going to get the right deal and we're not going to be confused by an arbitrary deadline. So it's looking like at the best case, the deadline for the tariff increase is delayed. Kyle Bass, U.S. government should ban all CCP propaganda outlets, beginning with People's Daily and CCTV for the imbecilic calls to arm against our government buildings. And here's the photo they put out. And this is in reference to really to United States supporting the protesters in Hong Kong. And so you can see this photo of the White House getting torn down and spray painted just like they're seeing in Hong Kong. Trump, something could happen regarding the 15th December tariff, but we are not discussing that yet. Talks are going well. How many times have we heard that? Global Times, if this sanction is really imposed on Huawei from the perspective of the US-China relations and the global financial chain, it would mean a substantial decoupling between the world's two largest economies. Okay, Huawei is the company that started off stealing stuff from Cisco, completely plagiarizing their instruction manuals. And the only thing they haven't really been able to steal are the processing chips. So Intel, some other high-tech processing chips are still light years ahead of China, supposedly. But what they have been able to do is become the #1 seller of phones in the world, bar none. And they've done this by actually selling cell phones at a loss. So hard for many companies to compete when a massive country like China is pulling all the resources of its entire country and supporting these certain industries they're trying to take over. So this is a big part of what the trade war is all about. And if US does not pull relief on Huawei, on the daughter of the CFO of Huawei, who's now stuck in Canada, this could be one very big piece of the trade deal breaking down. Donald Trump, do not believe any article or story you read that uses anonymous sources having to do with trade or any other subject. Only accept information if it has an actual living name on it. The fake news media makes up so many sources stay stories. Do not believe them. I believe in this instance, he's referencing the Bloomberg article that hit Sunday saying trade talks are doing great, but we can't say who said it. It's top secret. They don't want to be known. That's credible. Goldman Sachs, China may lower 2020 GDP growth to target, that's what's hilarious, target around 6%. So the way China is actually organized is all these small little territories with, I think they have about 50 million people in their CCP. And when President Xi changed the constitution, he forced all 55 million of those Communist Party members to hand write it and send it in. So they knew just exactly what was changed in the constitution, which was that he could be the leader for life rather than 5 years. Another funny thing is that the way their bureaucracy works is they tell them to hit a certain GDP goal. And so they just go and take communist land, sell it to a developer. The developer flips it to the populace who's borrowing from the Bank of China. And they're not allowed to ever show a loss because they're targeting GDP numbers. So the whole thing is a huge joke. And they're starting to see inflation. Their debt to GDP is near 300%. So if you want to know what happens when you grow your debt at this level and you create such a big real estate bust, a good country to study, it wasn't long ago, all the way up to 1990, Japan was going to be the big boy who's going to lead the world ahead. And where are they at now? China's Politburo vows to keep GDP growth in reasonable range in 2020 and to avoid systemic financial risks. So they're targeting 6% GDP. Kudlow, trade talks are intense, constructive, very important, almost daily. On CNBC this morning, Kudlow says Trump is not ready to sign any trade deal with China. Larry Kudlow said in an interview, this is from China, that US and China are close to a trade deal, probably even closer than in mid-November, but the administration was prepared to walk away if they didn't get the terms they wanted. Stock market, okay, now we're heading into US news. Stock market up a record. For this year alone, the Dow's up 18%, S&P 500 24%. And again, that's after it had crashed just about that much from October through December of the year before. So if you're a S&P 500 bag holder, you've had a 1-to-1 risk to reward ratio. And if this trade deal does break down, you're probably going to give it all right back. Here's the manufacturing pop, which is great news for middle of America. And you can see our manufacturing sector was gutted out from the dot-com period through 2010. Here's a heat map showing where the jobs are growing, primarily in the services. So we got a whole bunch of waiters, but also some growth in the goods producing. Here's a look at the growth of restaurant workers and bartenders. So not exactly the best job in the world, but it's keeping everybody busy and getting us that super low GDP unemployment print. Since September 11th, the Fed has injected $208 billion via repo and $111 billion via bill purchases, aka QE4. Here's a look at that breakdown. The only time the Fed has ever cut rates 3 times was right before a recession, every single time. They're very good at predicting it. Usually, though, they essentially let the bankers load up on bonds, let the stock market crash, a ton of money flow into bonds as they're cutting rates, which makes the value of your bonds go up. Then the central bank pulls the old trick where they buy the bonds from the banks. The banks now have made a huge profit, and now the banks can buy stocks at ultra cheap 50% off levels. So this happened in the dot-com bubble, happened again in 2008. Rather than letting the banks who cause all this mess go under, they bail them out. And so we can see the banks right now are doing just that. They're not loading up on stocks, they're loading up on bonds. I'll show you in a minute. It's official with today's $13 billion increase to the Fed's balance sheet. 2019 quantitative efforts are completely erased, and all in less than 3 months. So this was the reduction in the balance sheet, trying to be responsible central bankers. And the second they did that, we had 98% of all assets into 2018 in a loss. And by February, they did the Fed pivot and started cutting rates and doing quantitative easing. The repo market has been effectively nationalized. The Fed had to backpedal on rates and restart QE. Central banks keep loading up on gold. Whether or not these are telltale signs of the next crisis, such developments are not encouraging. In the past few weeks, repo fails have ticked back up again, though not yet suggesting the next fail swarm. Just a hint. In addition, dealers are now really hoarding T-bills. Over the last several weeks, they've increased their net position to the second most in 7 years. So these dealers are primarily, the biggest one by far is JP Morgan, is taking up about 25% of all the treasuries being issued. Here's a look at primary dealers' net UST position, and you can see it's at a very high level. US Atlanta Fed revised their GDP prediction a little bit higher for Q4. And now we're going into politics, top news. Nancy Pelosi, if we fail to stand up to President Trump, will be sending a message to all future presidents that they can simply ignore our system of checks and balances. So impeachment is pushing forward. Jeffrey Gundlach, this was a hit on Bloomberg. Political advice, if the theme is restoring America's soul and bringing people together. Don't fat shame, age shame, and insult a voter's IQ. So poor Bloomberg's not having good ratings yet. Most people are billionaires on paper because they own a bunch of stocks. Bloomberg, however, his company is private, and he's the 9th richest person in the world, or rather in the United States, at about $50 billion net worth. I think most of that's in cash. So that's a lot different than being stuck in a stock. Twitter censorship confirmed. Shadow banning is now written into the platform's new terms. Trump is on track to be impeached, possibly before Christmas. Nancy Pelosi said the House will draft articles of impeachment against the president for abusing his office by pressuring Ukraine to help win the 2020 election. Trump was defiant, reiterating that Democrats have no case and urging for a quick trial in the Senate, where there is virtually no chance that he will be convicted. Quotes, this is all out of Bloomberg. No choice but to act. Nancy Pelosi said the House will draft articles of impeachment against Trump. She told a reporter, "Don't mess with me," after he asked if she hates Trump. She got very upset about that. Biden lashed out on TV in Iowa saying you're a damn liar in relation to something about his son. France is striking against Macron. Hundreds of thousands of people in France walked off their jobs Thursday as more than 30 unions launched an open-ended nationwide strike to oppose Emmanuel Macron's pension reform plans. Now, this could be happening in America within the next 10 to 20 years, as our pensions are severely underfunded and rely on high interest rates to keep this paying. So if we continue to lower rates towards zero, that's going to put more and more pressure on the pensions. So we've got riots all over Lebanon, France, Hong Kong. Big picture is that central bank policy has increased cost of living dramatically, primarily in real estate costs, but really just everything. And meanwhile, wages have stayed relatively flat. So poor people around the world and average people are feeling the pain, and they're going to strip that money right away from the rich via taking over the government. So this is the big picture happening worldwide right now. More embarrassment for the Bidens. I just can't see how Joe Biden has a chance in this election, but he does remain the top poller currently. Hunter Biden ordered to produce 5 years of financial records. Baby mama must disclose stripper tips. He didn't make it to his trial. Here's Biden at his Iowa caucus. All right, that's a wrap of the top news. Let's take a look at this. Now, before I go into part of our boot camp program, let's go ahead and open it back up for questions, see where we're at with everyone. I've gone ahead and unmuted everyone. Murray, what are you thinking about the trade war so far?
It appears once again over optimistic.
Yeah, it sure does. Yulette, you have any questions so far?
No,
Following along pretty well?
yeah.
Okay, Ash, Jim, Manny, Ronald, William, any questions before we continue? Okay, great. Well, I'm gonna go ahead and continue on. And if you have questions, go ahead and feel free to post it in the chat or to hit the raise your hand button so I can unmute your audio. Okay. Okay, so now what we're going to do is a overview of the program, how it works, how we get our the big picture correct to generate safe returns. Okay, so this is part of our boot camp presentation once again. The easy way to predict markets and generate safe income. Daily income trade alerts at noon Eastern. Here's our current trade allocation and schedule. We trade the SPY ETF Monday, Wednesday, Friday at noon Eastern. I take the trades at about 30 minutes prior to them hitting your inbox. This allows us all to get very, very close to the exact same results. We trade the emerging markets ETF on Tuesday and TLT and GDX on Thursday. Again, all trades are delivered at noon Eastern. If you have $75,000, this is how you would allocate that 75,000. If you had 150, double it. If you had 300, quadruple it. I think you get the picture. So just multiply it. Keep the ratios. It's very simple. For every 100 shares of the SPY, you should have twice as many of these other assets. Now, if you're just starting, this is important. I would recommend only buying the underlying asset on the same day that you purchase the option caller. That way you're protected. You got to realize we're in a big bubble and all of these assets are highly risky. There's not a single investment asset in the world that's not overvalued right now. And this is because the Fed has had 0% interest rates for the better part of the last decade, which has spurred a lot of malinvestment. So we're playing it very safe, realizing we're at the end of a business cycle. So a good way to do it is buy the SPY on perhaps a Wednesday, then do the TLT and GDX on a Thursday, and then follow into the rest of the program after that. So really the best way to enter into the program would most likely be either on a Wednesday or a Thursday so that you can pick up the stocks and bonds at a very close time period. And we do have a new fellow who joined in. Lewis, welcome. If you have a microphone, we'd love to hear from you. This replay will go out this evening in case you missed some of the content. All right, so our goal is to generate 1% a month. We don't always hit our target. I'm much more concerned about avoiding loss. So if there's a definite danger right ahead of our nose, like we have right now, which is that December 15th tariffs going up, we're going to play it safe. Also, a lot of the times we have to be patient for the bond market to pay out. Typically, bonds will just slowly pull back until there's fear and then it spikes higher. So it's more of a slow bleed and then capture the win. SPY is a lot different. SPY, we can have very consistent wins and we're trading it 3 times a week. So the SPY is more like our bread and butter, whereas the bond and gold market is more like your 30-yard touchdown pass, I guess. To date, we've had an average return of 1.25%, profits in 11 of the past 12 months, and our largest drawdown in a single month is negative 1%. We lost 1% in July, predicting the trade talks would break down. They came out saying, guess what? We're going to have a farm purchase agreement, which of course did not happen. And in August, Trump raised the tariffs, and we did catch a good win that following month. Never lost capital over a 90-day period. And again, we do outperform most investors when equities are falling. We don't tend to lose money when they go up. We just don't get the same return as the market. And that's because we have half of our assets in gold and bonds. So of course, we're not going to be able to outperform the SPY when we're trading such a conservative system. Also, the option callers will typically be a drag on our return, and they really pay off when things get hairy. So this has probably been the easiest year of trading that I've seen in a long time. Just about every asset has gone up, and that typically does not last for long. So I would suspect that in 2020, heading into the election, heading into the trade war potentially escalating, and also being able to watch from afar China's GDP growth collapsing below 6% next year, I think trading is going to get a lot more difficult. May, when we had a pullback, we pulled in 2.2% return. August, we were not positioned to bet on a trade deal breaking down. July, they told us they're going to purchase some agricultural products, and I believed them. But because we had our bond position and our option callers, we were able to cut off the loss on the SPY very quickly and flip to the inverted option, and then the TLT jumped. So we did get a nice return in August. September and October, the TLT is sold off considerably, pulling back some of our profits we've collected on the SPY. But overall, I'm very happy with the returns we have generated, considering how risky this market is. Our simple 4 ETF portfolio is extremely diversified and all you'll need for your retirement. Our goal is to generate income and safety not growth or speculation. You can simplify your holdings, reduce your risk, get better results with less work, and weatherproof your retirement portfolio. Now we have 3 basic slides to teach you how we're going to play the markets based on what's happening with the most important fundamental catalyst in the market. And that's whether the trade war is up in the air, escalating, or de-escalating. So I'm going to go back through these 3 because they're very important. We're not going to change the assets we own no matter what's happening. We're only going to alter the options to derive a profit based on where we think each asset is headed. In general, we have interest rates heading to 0, currently at 1.75. We have low inflation, at least by the metric the Fed looks at and from their FOMC meetings. And we have quantitative easing. So that's the formula for everything to bubble up. So in general, we want to be long all of these assets when there's not fear in the market. So you can see with the plus sign next to SPY, plus sign next to emerging markets, plus sign next to TLT, as long as everything is just up in the air and there's no certainty as to whether we have a trade deal or we don't, we've seen all of these assets bubble up. In fact, all year, that's exactly what they've done. So I will play GDX relatively tight with my options when there's no big panic. But I will be long all of these assets during a period where there's no confirmation that there is a trade deal or isn't a trade deal. And we'll look at how the options are optimized for these different circumstances. Now, my expectation is the trade war will escalate. We're not playing it with that setup yet because it has not yet escalated. It started to on Tuesday, but then they went right back to up in the air. So if the trade war actually escalates and there is physical proof, a tweet, something at a public forum like NATO in London just last week, if there's real catalysts, we will use an inverted option collar on the SPY and emerging markets, and then we'll get more bullish on both the TLT and GDX. So that's what I think is most likely to occur within the next 30 days, possibly within the next 9, because the deadline is supposed to be the 15th, although I could see them simply pushing that further. Now, the other potential outcome that we have to be ready to jump on is if the trade war de-escalates. If that happens, I expect SPY can travel significantly higher, probably above 330 quite quickly, and maybe tap out around 360 at some point into 2020. At that point, we'll probably start getting worried about phase 2. Now, if that's the case, there will be some short-term volatility in bonds and gold, so we'll be playing those to the downside. Here's our 3 option setups that allows us to profit and to own the asset and derive a profit with whichever direction we think the asset's going. So if we do think the asset's traveling higher, the best way to get the profit is just letting the asset go up, but using the option collar to protect us just in case we're incorrect. So this is what I call the bullish loose option collar. I'm selling an out-of-the-money call option and buying an out-of-the-money put. In this setup example, we have a maximum return of about 1% in this period, $3 to the upside. We also have 1% downside risk, $3 to the downside. By selling the 301 call, we would give up all profits after it traveled above that price level. And in this example, we're at 298. On the other side of the coin, because we're long the put, we can't lose below 295. So the SPY could crash to 290 tomorrow because trade war broke down. North Korea is firing nukes. Who knows? And no matter what, because you bought your insurance, you're protected to the downside. Now, the trade we actually put on Wednesday, which lost out on a bunch of profits today, but still hit its maximum return, was this neutral tight option collar. So in this setup, we'll sell an at-the-money option for a big credit, and then we'll use part of that to buy our downside protection. So in this setup, you can see our maximum profit was $1 and our maximum loss was $1. So we're only trying to make or lose about 0.33%. in a trading period with a tight option collar. So typically I'll want to put one of these on when I suspect we're near a top and pretty much just waiting for a catalyst to create a sell-off, which is where I think we're just about ready to be at in the SPY. And then finally, this is the most profitable setup, but we get to use it the least because the entire financial system is engineered to go up over time. But that, as you'll see in a minute, is potentially coming to an end. We have the bearish inverted option collar. We sell an in-the-money call option for a huge credit, and then we buy an in-the-money put. So this actually allows us to own the asset and generate a profit to the downside. As the SPY travels lower, we'll get to pocket that call option we sold. Plus, we'll get to realize a large profit from our put option. So we actually generate a profit if it goes below the covered call we sold in this example. And you can see we get a 2-to-1 risk to reward ratio, which really only happens typically when you're betting down. So you can see we can generate $2 of profit per share and only risk a maximum of $1. Now, it's really important that we all understand these 3 slides. Let me go ahead and unmute it and see if we have any questions about this, as it can be a little bit confusing. Any questions out there on these 3 slides? I do want to point out where the profits derive. So in a bullish loose option collar, expect, if we're right and we're going to hit our max profit, you're going to generate the profit from the asset traveling above the call we sold. But expect your short call and your long put to show a loss. That's how this trade's designed. In this setup, we're going to generate potentially most of the profit from the call option we sold. We're not going to generate a profit from the SPY traveling higher, and we're going to lose money on the put. For example, your underlying asset will lose value, but you're going to make more profit on the options. So in this setup, both of your options will lose money. Your underlying asset delivers the profit. In this setup, SPY is flat, no profit loss. Call option generates a profit, and your put option loses. And in the bearish setup, your underlying asset will lose value, but both of your options will generate a profit. And so I know for Murray, it took a little while to get used to that because it's different in all 3 scenarios. You've got a pretty good grasp on that now, Murray? Eulette, does that make sense to you? Are you pretty familiar with doing this type of trading?
No,
Doesn't make sense?
nope.
Okay, no problem. So yeah, let me walk. This is probably the most important thing to understand here. Let's start off with the more common one, the bullish loose option collar. So I'll just walk you through all the terminology so it's all crystal clear. So in our program, we only do really 2 types of option trades. We sell call options, which I relate to something like taking candy from a baby. It's primarily stock speculators who want to get rich. They don't have enough money to buy 100 shares of the SPY. So they sit there and they bet it's going to go up, up, up. And so we love to do that. It generates consistent income and kind of makes us like a landlord. Now, on the other side of the trade, we're buying put options. Now, the people who sell put options on the other side of that are gigantic banks, like insurance companies almost. So it's kind of like we're leasing out our property for 48 hours to a poor guy who just can't afford the property, wants to stay there. And then we're taking part of his money and using it to buy insurance to protect our house. So that's kind of what this setup is like right here. So let's just look at what all this means. So if I sell a 301 call option, that just means I'm agreeing to sell my shares for $301 per share. So in this example, you can see the last trading price is $2.98. So this means the person who purchased the option contract, he wants to buy my shares for 301. He'll only do that if the value in the future is above 301. So from his standpoint, he's paying me 33 cents, which you can see right here, for the right to buy my shares at 301. So, okay, from my standpoint, that's not a bad deal. Right now, my shares are worth 298. I don't know what they'll be worth in 2 days, but this guy is willing to pay me 33 cents a share, or $33 a contract, to buy them for a profit in the future. So that's a great deal for us. So bottom line is we'll get to sell them for 301 a share. That's $3 profit per share, plus keep his option premium of 33 cents. And so if it were to go much, much higher, let's say it went to 310 in 2 days, completely unheard of. Let's just say it happened. Well, the call option buyer is going to be able to go sell those shares in the market for 310 and buy them from us for 301. So he's going to pocket $9 a share, and he only had to pay us 33 cents to do that. So that's what the option buyer is thinking. We do not lose in any way, shape, or form if the trade goes in our direction well above that call option. And I have found that's a common fear of people. So if we sell a call option and we're assigned, we're going to get the maximum profit on the long side of the trade. So does that part of the trade make sense?
Yeah, but I thought selling a call is because you think it's going to go down.
It's considered a bearish trade. That's true. But if you sell a covered call, you can never protect. Selling covered calls to protect to the downside is a fool's errand. You can really only, so in this example, this would only protect 33 cents of downside. And the problem is the SPY has been dropping $5, $10, $20 in short periods of time on just bad trade news. So if you really want to protect to your downside and have absolute protection, selling a call option will never, ever accomplish that. Call options are good for generating income. And in this example, we're going to go ahead and, so you're right, it's considered a bearish trade. But I just want to be crystal clear. If we go above 301 and are assigned, that's great. You don't lose. So just to understand, the SPY's at 298. I'm agreeing to sell my shares to the option buyer for 301. So if he, for whatever reason, exercises his right, I pick up a profit of $3 a share and I keep his 33 cents. That's really all you need to know about that trade. Does that make sense for at least that half of the trade? We'll talk about the put next.
Yeah.
Okay.
Well, do you hold it through assignment, and when is it settled?
Okay, great question. So in the last year, we've maybe had 3 or 4 assignments, so it's very rare. The way an option assignment works is it's a lottery system. So even if, let's say, Murray is assigned overnight, that doesn't necessarily mean you will, even though you guys took the exact same trade. Okay, so here's what happens. Let's say the SPY flew way above the strike we sold a call option. That's the only time that someone would want to exercise their right so they can pull in a profit. So let's say they did it today. They exercise their right today. Monday morning, you're going to get a big cash balance. So you're going to get 301 a share in this example, and you're going to keep that 33 cents. So if you were assigned today, you would not know until Monday morning. And what would happen is you'd still own your put option, but you would be forced to sell your shares for the agreement. So the agreement in this case was 301 a share, plus you keep that 33 cents. So come Monday, you're going to have to buy back your 100 shares and then enter the new option trade. Now, a lot of people are scared of writing options because they've heard of, nightmare scenarios. I think I need to unmute Dean. Dean, you still out there? Sorry, I think I had you muted because you had a phone call. A lot of people have heard nightmare stories about selling put options, and you should be absolutely fearful of selling puts. The exact opposite happens in that setup. So we'll talk about that. Let's just make sure we understand the engineering and how selling a call option works. So if we sell a call option, we can never lose money from the asset traveling higher. What we can do is miss out on profit potential. That's what happened on today's trade. So we sold the 311.50 and had it was the trade we did on Wednesday was more like this, where we were going to hit our maximum profit if it just stayed flat. So we hit our maximum profit, but unfortunately the SPY went way higher. We missed out on some profit. So the guy who bought the call option, he made a huge return, guessing that the SPY would jump $5. So good for him, but it didn't lose us a penny.
Two guys. Are you here? Yeah, I'm here in the kitchen.
Okay, so that side of the trade makes sense, Yulette? And William?
Yes.
Yeah. Yes.
Okay, great. So let's talk about the other side. So when you sell an option, that's called being short. So we're short a call option, it's bearish. If we're right, the call option is going to lose this money, but the underlying asset delivers the profit. That's if we have to cover the call option. If we're assigned, you're going to end up in cash, and you're going to hit your maximum profit on the long side of the trade. Okay, so that's really all you got to know about that half of our trade. Now, let's say the trade goes against us. Okay, so stock market is extremely highly priced. We're at PE ratios around 18. This is assuming, and this is during a period where earnings growth just went negative this month. So we have a market that is priced for perfection. Let's say something bad happens. SPY tanks 5, 10, 20, 30 bucks over a trading period. How does this put option actually guarantee us we get that price? So this will be the exact opposite. We're not going to end up in cash and assigned by being long a put option. So the basic math on the put option is simply the second you go below 296 in this example, whatever strike you've bought your put, the second the SPY goes below that level, your losses are cut off. So what's going to happen is we're going to have a very high return on the short call, probably around, let's just say in this example, we did go below 296. Realistically, let's just say we went to 295. Well, if we went to 295, this call option might be worth 5, 10 cents come expiration. So we buy that back. So we pocket $1.50 profit or so, maybe $1.45 on the call option we sold. Our underlying asset has lost value, clearly. So we went from 298 to 295. So we're going to lose $3 on that. But what's going to happen to the value of your put option? It's going to go up rapidly. So let's say this happened between now and Monday. Well, Monday comes around, SPY is tanked. Your call option you sold will be showing a big profit. Your underlying asset will be showing a loss, and your put option will be showing a big profit. And so essentially, we're going to get 296 minus the premium we paid per share of the SPY. Plus, we're also going to get to keep most of the call option we purchased or we sold. Does that make sense? So the most clever thing you can do is sell call options to finance a cheap put option. A call option won't hurt you from generating a profit to the upside, but it does give you a free way to finance constant insurance. So think about it. Would you not have medical insurance at this point in your life? Probably not a good idea, right? Well, should you own stocks at all-time highs at the end of a 11-year business cycle in front of a trade war with no downside protection? Probably not a great idea. So selling a call option can provide a little downside protection, like a little cushion, but it's not going to provide absolute downside protection. The put option provides absolute downside protection. And so depending on which trade setup we're in, we can optimize that. Does this make sense to you, William?
Yep.
Okay, now this one's a little more confusing. So let's go through this one together, William. So in this example, we call it the inverted option collar. So the SPY is at 298. I've agreed to sell my shares for what price in this example?
297.
Okay, so what loss am I taking on the underlying without looking at the option premium?
$1 a share.
Okay, now how much option premium am I collecting to put that trade on?
219.
So what's the net profit? Forget the put. Let's just say we get assigned because the SPY goes up. What's our net profit on that?
$1.19.
He's good. You're hired. Okay. So, all right. So we sold an in the money call option, but the premium on that is substantial, $1.20 more than what we're losing on the underlying asset. Now once again, we could sell an in the money covered call all day long, but if the SPY drops at all, it's not going to protect your losses. At most, you're going to get maybe $1.50 of protection downside. The put options where you can actually turn a profit with this setup. So we can actually own the asset, sell the in the money covered call, buy the in the money put, and make very substantial profits to the downside. So you can see I've purchased a put option that's worth more than the SPY is currently. So I had to pay a huge premium for that. And in fact, it's about a 27-cent premium. So I've got a put option writer who's willing to buy my shares for $2 more than they're worth for a premium of 27 cents. That's not a bad deal, is it? And so if we're wrong and the SPY travels higher, the maximum loss in this example is $1 a share. But if we're correct and the SPY does travel lower, this would have a maximum profit at expiration of $1.95. Now, what I'm about to tell you is a little bit more advanced part of our boot camp, but we're closing these positions out with option or with time premium left. So that means if the implied volatility is up, which always happens when stocks go lower, this is not going to accurately show you how much money you can make. So we'll actually make more than the trade chart illustrates when implied volatility is going up. So it means our put option will be worth more than this is calculating at the exact expiration date. So we love to put these on, but again, we need the right environment to put that trade on.
Does the SPY settle at the end of the market or at the beginning of the market?
We're never settling at the close is when the options settle.
Okay.
We're always rolling over the position. So we always have to buy back our call option so that we can roll over into the next position. And so we have these positions open 24/7, 365. And because you can see by, first of all, overlapping the TLT and SPY, that's a huge level of security just in itself. And then you throw on a put option right below all four assets, you can see why it's very hard to lose money.
Mm-hmm.
So we're constantly having all four positions open at all times. The only time you'll be out of a position will be for a couple hours in the morning in the rare chance that you're assigned. And if you are assigned, that's good. That means you hit your maximum profit and good for you. Okay, so any questions on these three slides?
Mm-mm.
Okay, great. All right, I'm gonna go ahead and move along here. probably go for about another 30 minutes and wrap today's webinar up. Okay, so number one thing I'm tracking is the Fed. Now, it's not just looking at a little chart like this. It's actually paying close attention to all their interviews, their FOMC meetings, and other central banks as well. But the most important manipulator of the markets is clearly the central banks. They've got printing press, and they love to use it. And in general, if they're printing, assets go up. If they're flat, we got to get a little more careful. And if they're selling assets, then pretty much every asset will collapse, including stocks and bonds. So we saw that in 2018. They tried to raise interest rates to a healthy level, which I'm all for. And they tried to reduce the balance sheet, which all Americans should be for. But the problem is that made every asset class by the end of the year collapse. And so here's the big picture. Everyone really needs to print it out, put this on your wall. This is the single most important thing that most investors don't get. We're not in a 10-year bull market. We're really in a 40-year bull market. And it's because the Federal Reserve was starting at interest rates of 20%. Go back to the 70s, we had runaway inflation from very loose monetary policy. In the 60s, we had the Cold War. We had massive social programs. We spent too much. We made too little. The money finally made its way into the real economy, and you got runaway inflation. So from the 70s through the 80s, Paul Volcker jacked those rates up so high. Imagine getting 20% a year from your bank just to put cash in it. That's how bad things got. So when you can lower interest rates, that's what pushes markets higher. And that changes the cost of money. And so in the last decade, we've had 0% rates, which has caused low inflation because it's fueling corporations that lose money. Think of Netflix, think of Uber. If they couldn't get free money from the stock market by selling bonds to the banks for, borrowing from the Fed at extremely low rates, they're not going to be running a business model that loses a couple $1 billion a month. Okay, and this is a worldwide problem. In fact, the US has some of the highest interest rates in the world. And nobody ever thought hitting zero in the US would be possible, but now we've got Japan and Europe at negative rates, which is dry, and Germany. So the lower they go, the lower we're going to go. It's all a relative. But the big picture here is that there's no more ammunition for the Fed to save the day. And if you look at each gray line, you can see what did the Fed have to do to get the economy out of recession. Okay, go back to the Asian crisis in '89 when US jacked up rates, caused many currencies in Asia to collapse, ended up turning into a huge recession. There's a lot of other stuff going on in that period. All that I really want you to pay attention to is that the Fed not only predicted a recession before it occurred, what they had to do is drop rates from 10% all the way down to, sorry, let me get that darn thing out of there, to 3%. So they had to cut the cost of money by 7%, 700 basis points. Huge cut. All right, they got out of that problem, tried to get rates back up to a healthy level. We had a boom from 1990 through 2000. And then what happened? Well, they pushed those rates too high, caused the cost of money to go up, caused debt growth to slow down, and that causes GDP to go negative. We got another crash. They saw the crash coming from a mile away, and what did they do? They were cutting rates before it happened. And in the dot-com bubble, they had to cut rates from just about 7% to 2%. So again, another 5% cut in the cost of money to get us out of a recession. Okay, they knew there's more problems ahead. They needed to get rates back up. They were able to get rates to 5% before the dot-com, or rather the housing bubble collapsed. And to save that day, once again, they had to cut rates from 5% down to 0%. So we're now living in the greatest asset bubble of all time because money has essentially been free for the better part of the last decade. Now, what did they try to do? Things are looking good. Once Trump came in, tax cuts, everything's going straight up. well, let's try to increase the rates so we can protect against the next recession. They barely made it to 2.5% this time. The more debt the world has, the more sensitive it becomes to these changes in rates. And right away, by the end of 2018, all asset classes worldwide had collapsed and forced the Fed's hand to go back to quantitative easing and cutting rates at the same time. Now, normally they cut the rates first, which makes the value of bonds go up. So your banks are loading up on bonds into this because guess who owns the Federal Reserve? Not the government. The banks own the Federal Reserve. So if you don't think they're in cahoots, we've got news for you. And so during panic and crisis, they can get away with purchasing these bonds from the banks, massive profits, even though they're causing all these distortions. And then what do the banks do? They get to turn around and buy stocks at 50 cents on the dollar. So they've been doing this consistently, but now they're very afraid because they know they can't cut rates anywhere near as much as they have in the past unless they want to go negative. So what are they doing today? They've cut 3 times this year, 75 basis points, and they've printed $320 billion. So that cashed out massive profits, mainly for JP Morgan. And now JP Morgan's, once again, they're not buying stocks. They're loading up on treasuries, signaling that they are not buying a trade deal. So it ruins this strategy of being long stocks and bonds is primarily inflation. So let's take a quick look at some inflation throughout history and also look at the relationship of our assets. So in this picture, we can see the SPY and the TLT. They both have gone up together. This is due to interest rates slowly going lower and lower. Now, the entire financial system, all major hedge funds, everybody relies on this relationship that they're going to go up over time together. And when one goes down, the other goes up. So we can see in the orange line, the TLT, that's your long end of the treasury market, the bond market. And every time stocks tank, TLT goes up. And so again, TLT typically slow bleeds your account. And then when panic hits the markets, it spikes up. So in our program, expect very high probability win rate on the SPY trades and the emerging market trade, and to see your returns a little more bouncy on the TLT. But that TLT does pay off considerably every single time stocks sell off. But the problem is we're getting to the end of the rope where this strategy works. And I'm going to show you that when interest rates are traveling higher, this relationship breaks and they both just go down together. And so you can see from 1970 through 1980, and really from 1965 through 1980, you had a 15-year bear market in stocks and bonds. Now, my timeline to get to zero is about 24 months. That's just saying 25 basis points every 3 months gives you a 24-month timeline to hit zero. Now, if we start to have a real slowdown in earnings, we see the trade war escalate, we see China's GDP go below 6, we see Germany starting to dip into negative yielding bonds, well, this timeline is going to be sped up. So it could be shortened considerably if there's panic. Here's a look at the TLT. Once again, you can see the same pattern, slow bleed, and then jump. Slow bleed, and then jump. So we're trying to time that as best as we can. But my expectation is for the TLT, the big fear is what are people who are buying bonds today going to do when they realize we're near the lowest rate that we can push interest rates, which will be probably zero. And so I think the TLT has about $40 of upside potential before the market starts to freak out. Now, the Fed's talking about how to deal with getting to the effective lower bound, and they're talking about a lot of things Japan did. So hope to God that doesn't happen. Too much to cover in today's, but just realize unless we want yields to spike, stock market to crash, and the US government to be unfunded, TLT absolutely, positively has to go higher. Otherwise, everyone who's purchased a bond is realizing its yield is below inflation and a total loss. And if they hold on to it, because the Fed allows yields to go higher, they're going to be holding onto a negative return on the value of their bond and a yield that's less than inflation. So this has to be manipulated by the central bank higher. And the potential is probably a maximum of about $40 of upside on the TLT. And at that point, we have to think about what's the Fed going to do. They're talking about capping the maximum yield, which would entail gigantic amounts of quantitative easing. They're talking about an unlimited repo market. And they're now talking about negative interest rates. So we'll see how that develops. That's just in their most recent FOMC meetings. Now, what we're looking at here is just a little zoomed in, just TLT against SPY. I want you to note that they really provide a huge dance together. One goes down, the other goes up. So we're not going to capture gains on the TLT and the SPY at the same time, but over time, they will go up together until we get to the end of the rope, which is probably at most 24 months away. So in this example, you can see stocks flew up 51% over the course of 2 years, but the TLT provided all that protection for you and very little drawdown over the period. So you cut your return in half, but you made it almost impossible to have a large loss in your account. And so you can just see over any trading period, it's almost exactly the same. Now, gold is a part of our portfolio, but I want to make it clear I'm happy to profit from gold crashing just as much as I am from it going up. My expectation is it's going to go significantly higher because we're about to go into massive, massive amounts of quantitative easing as we get towards the lower bound of the federal funds rate. So with gold, I look for 3 things. Number one, are interest rates headed lower? I would predict that, yes, they will go lower over the next 24 months. 2, and they have already over the last 6 months, 3 times. 2, is the Federal Reserve buying bonds? Yes, at record pace, faster than ever before in history. 3, is there potential for fear in the market? Yeah, we've got impeachment, we've got China slowing down its GDP, plus we've got a trade war. So yes, there's definitely some fear headed our way. So that's why we're playing gold to the upside currently. Also, gold for most of the time will have a very similar path as bonds, but they do break paths at certain points in time. So it is important that all of our assets are not completely correlated. In fact, they're very uncorrelated. But over time, if we can get the big picture right on each asset, we can generate a profit on each asset at a different time frame. Now, we played spot gold expecting the Fed to make these moves, and we did very well with that this year. Now that they've already begun making the moves, I'm much more inclined to own the miners. So while spot gold might be stuck at 1,500, as central banks around the world are buying it to try to provide credibility to their local currencies, that's going to drive a few lucky miners who actually have capital to mine gold to make some big profits. So the upside for GDX is to go at least above 64, where we saw it hit from the quantitative easing done in 2009 through 2011. So we got a lot of upside on that. What's in the SPY? It's 500 companies. It's the largest fund in the world at $262 billion in assets, and it trades $20 billion a day. It's the single most liquid security in the world. It's overweight in technology and financials, and you got your biggest companies. Now, if you own a stock that's not on this list, I would not have that in my portfolio. That's highly risky. Just think about it. Most money these days doesn't buy stocks, they buy ETFs. The ETF turns around and flows the money straight to primarily this group of 10 US companies. And so it's no wonder why Microsoft and Apple appear like they just go straight up every day. Well, they're getting the bulk of the funds from this ETF. So again, if you're owning specific stocks, you're probably better off just owning the SPY. Okay, emerging markets. Here's a look at that chart. It's a $25 billion fund, has 1,000 companies in it. It's highly diversified. It is primarily in China through Hong Kong Exchange, South Korea, Taiwan, India, Brazil, South Africa, Russia. It's everything except Japan, really, over in Asia, and also excluding Europe. Biggest companies that are most important are Alibaba and Tencent, two gigantic companies supported by the government of China, and two of the top 10 companies in the world in terms of revenue. Also, we do want to be long China. If a trade deal is reached, they've got a lot more people to sell products to, and they're growing rapidly. And now they're not just stealing stuff, they're also starting to innovate and create better products for their culture, which is, they don't have email, they use WeChat. They don't use anything American. They've completely ripped it off, merged them into multi-use apps, and have outperformed many American companies. So they've gone from just stealing to having stolen perhaps the golden goose, and now they've planted the seed and they're growing at rapid pace. Now that doesn't mean there's a lot of problems with China. I'm happy to critique them. Primarily their housing bubble and construction bubble will probably be the detriment to China and to the world, as they're allowing that bubble to pop right now as we speak. GDX is your gold miner ETF, has 55 companies, most of the gold mining's out in Canada, and most of the money is going to Newmont Gold Corp and Barrick Gold Corp. So Barrick Gold is a huge position in Stanley Druckenmiller's portfolio, probably the highest returning hedge fund manager of all time, next to maybe James Simon, managing a lot less money than some of the folks like Ray Dalio. BlackRock, which is the biggest money manager, I can't remember how many trillions they manage. They own almost all of Newmont Gold. And so when you look at this short window, we have maybe a couple of years for gold miners to get the barbaric relic out of the ground, sell it to the central banks before this whole thing goes haywire on us. You want to own the big companies that can actually mine. If you look at the balance sheet of any company that's not on this list, you're going to see that they're losing. Their net income is negative. They have no intentions of mining any gold. They're going to take your money and run investor relation ads, and then go pay their management and run some more investor relations ads. It's a huge joke. That's why it's very important to note that this is 61% of the entire GDX ETF is going straight to these 10 companies. So I can't remember how many portfolios I've looked at where you have minor junior mining companies that are a total waste of money. These are the guys who can get the capital to go dig up the gold, which is expensive, and go get it to the market while we still have time. Okay, so when does the long bond stock strategy break down? Rising rates into quantitative easing, inflation, deflation. We're going to go look at the past 100 years in a minute, but let's just look at what I think might happen. And again, this is the Dow. A lot of people I talk to, seven-figure portfolios, they think the worst thing that could happen to them is they get a one-year bear market like 08, and it rebounds right back. That's what they think. But they don't realize that there's been plenty of periods of time where stocks and bonds can return negative returns for over a decade at a time. And so the Great Depression from 1930 is a great example, all the way to 1945. And then from 1965 into 1980, during another period of runaway inflation, was also another period of negative returns in stocks and bonds that lasted for 15 years. In fact, if you had gone all in 1965, it would have taken you 30 years to get back to break even in 1990. So that's not something our investors can afford to hang on to. Jim, I noticed you joined back. Welcome back. Let's take a look at what I think is going to happen, and then we'll take a look at the history in more detail. I believe within the next 24 months or less, a crisis hits, a recession, a trade war escalating. earnings growth, the credit market snaps, corporate buyback scheme breaks. In this instance, we're going to be using the inverted option collar on the stocks, SPY and emerging markets. We're going to be long stocks and bonds. This will probably get us to that maximum price tag on the TLT, unless we go to negative rates, which I don't think they're ruling out. But if we were to, we got a new fellow joining in. Karan, welcome. You will get the webinar replay later if you're joining in late. But so my price tag for TLT is around 180, and that would be by pushing rates towards zero. If we go to negative rates, maybe even a little bit higher, but not much. Bottom line is this would expedite getting to the lower bound of what the Fed can do to save the day. There'll be massive quantitative easing, and we'll probably have a relatively short-lived stock crash. And that's because money's free. So banks will be, the banks are already doing this. JP Morgan has increased their bond position by 50%, not their stock position, their bond position. So what does this mean? Rates go lower, bond prices go up, the banks get bailed out, and they have a huge amount of cash. What happens next? You get your rebound in your stocks. And now people who've bought bonds are wondering, what on earth did they buy them for? They are yielding less than they could have made. They're yielding less than inflation. So they're a loss from, if you hold, the yield's going to be super low, maybe below 1.5% on that 30-year. So people are going to flood out of bonds at record pace once they think there's no more capital appreciation in them. And that's all the Fed's talking about right now. They're not talking about increasing rates. That would be a disaster. All they're talking about is how are we going to keep the credit market intact once investors don't believe the Fed can push rates lower. So their three strategies are either negative rates, putting a cap on yields, which would be massive quantitative easing. Look at Japan, and permanent repo. So that's their plans. So at some point, the bond market's going to freak out and think, all right, this is a stupid deal. I don't want to take a 1.5%, maybe 1% yield for 30 years when inflation's well over 2%. So at this period, we're probably going to see the biggest pop in gold and be wanting to take profits on that at near this time period. And you're going to see most likely a nice rebound in stocks and emerging markets. Now, remember, a ton of money was just let out of the stock market, which is going to start pushing inflation. What happens next? Well, inflation comes back in. We have rising rates from the Fed. They have to raise interest rates because we're starting to get what we saw in the 70s and in 1965. And you're going to end up wanting to short everything under the sun. This is Ray Dalio's big prediction. He's been talking about this for quite some time. And this is the big reset. So this has happened really twice in history. So he looks at cycles, 10-year cycles and 50-year cycles. And so we had a big cycle in the 30s, and we had another big cycle in the 70s. And now we're looking at potentially another massive reset in the near future. And that's because we're at near 0% rates with more debt in the world than ever before in history. So this could take quite some time to get the inflation out of the system, get all the bad investments out of the system, and start getting clean economic growth. So during this period, we're going to be using our inverted option collar on all assets, and we'll probably make more money than any other trading period. This will be absolute heaven for us when we get to this period. And then what happens? Well, eventually you get from the transition from your Paul Volcker, where you've got runaway inflation, you've jacked up rates. He jacked them all the way up to 20%. The 200-year average of the cost of money has been 5%. So we're most likely going to overshoot that to get inflation under control and then drop it back down. So we'll be sitting on very high interest rates, a massive reset. That's when we're going to want to rotate back into stocks, bonds, and continue shorting gold all the way down to the bottom. Now, how long can the next reset last? Probably a while, because we're gonna get all that malinvestment out and maybe get your next fresh business cycle. Now, does that not mean we're gonna have potentially 10-year business cycles within the bigger cycle? Sure. So what's inflation all about? Well, we've got this funny game where the Fed makes the cost of money free or near free. So the Fed lends money to JP Morgan for cheap. JP Morgan turns around and buys corporate bonds for cheap. Corporation turns around and number one, they buy back their own stock. And then two, they don't care about generating profits. So Microsoft actually is borrowing money overseas in Europe at a negative rate. So imagine that, getting paid to borrow money. What in the hell is going on here? So that's where we're at. So these companies are being incentivized to have a business plan that does not generate profit. They generate market share. And so they're having to compete with other businesses that are also trying to generate market share and not profit. So this has been driving inflation lower and lower and lower. Companies like Huawei are out there selling phones, taking over the market in 10 years at a loss. They're selling phones at a loss. Netflix, losing money. Uber, losing money. The list goes on and on and on. If you go look at SoftBank, this massive, just think about WeWork, Peloton, the list goes on and on. But it's a self-fulfilling cycle. Inflation's going lower, at least on these consumer goods that corporations sell, because they're getting free capital from the Fed, from the bond market, and they're competing with one another. So they have to sell at a loss to take over market share. So what happens? Well, eventually inflation ruins the party like it has many times before. In this chart, we can see the consumer price index in blue, and we can see the effective federal funds rate in red. Every time the blue line spikes, you can bet what the Fed will do. They will jack that interest rate up, the cost of money right above inflation, and inflation disappears. What you also get is negative GDP prints. Funny. Most of our growth is from an increase in debt. That's really how we add money to the economy. And it makes sense as more people are born and technology automates things and increases productivity. We need more money to represent the value of our economy. So that's fine and dandy. But every time we stop growing the debt and increase the cost of money, you get negative GDP prints, which means your corporations are showing losses and you get stock crashes. So when rates go up, you get the double whammy. You get your bond market to crash really quickly and then followed shortly after the stock market. And so if we can predict what the Fed has to do, you can see Treasury rates are a magnet to the federal fund rate. Now, a lot of people like to say, oh, the bond market's forcing the Fed. It's not true. The bond market's predicting ahead of time what the Fed will do, just like the stock market is trying to be ahead of what's going to happen. And so right now, the basic thing you need to know is the government is creating massive deficits that it can't pay for with its tax receipts. So it has to sell these bonds primarily to JP Morgan and as much as they can to foreign investors. But if these bondholders think for 1 minute that inflation is going to go over their yield or that rates are going to go up, they're all going to sell these trillions of dollars of bonds at once. So the Fed has no choice. All they can do is slowly drop rates and try to keep this together. Now, what's Kudlow's hope to save the day? Their hope is that they can get GDP above 3% and get our debt level of growth below 3%. And that would actually be our economy growing in a positive fashion. But the case right now is that our debt is growing much faster than our GDP, probably about twice as fast. So we're headed down a bad path currently. And that's not just us, it's every country around the world. China's far worse in terms of the debt versus the growth. And that's because they've been building, we're building companies like Netflix or whatever with the malinvestment of capital. China is building ghost cities, complete loss. At least Netflix is making some money. A lot of the stuff the Chinese have built are just crumbling into cracking cement blocks. Okay, so let's look at inflation. Another big risk is that populism is going to get into the governments and change the system. They're going to take money from the corporations and the wealthy and redistribute it because they're not happy. The whole way this has been architected has been very beneficial to the owners of corporations and very unbeneficial to the workers. And so their costs have gone up, but their income has stayed flat. And so you can see 2% CPI growth is actually a lot over the course of 10 years when your income's not increased by 50%. Now, the scary thing is the Fed should already be raising rates clearly, but they changed the CPI formula so they can keep getting away with these low rates. If you go back to the 1990 formula, we're sitting at almost 6% inflation. So the federal funds rate should be maybe 6.5%. Enough to be above the inflation rate. It's not, it's below 2. What about if we go back to the 1980 metric? It's even more startling. Now we can see that inflation's in an uptrend. It's not a steady 6% inflation. It's getting worse by the year. So this reminds me of what Paul Volcker did, and he jacked up rates all the way to 20% over the course of a decade. And finally, he got the malinvestment out of the economy and got a nice reset and gave us the biggest boom in the stock market of history from the 80s till current. And so, you know, we're all cheerleading today, 3.5% unemployment rate. But what do you think happens when companies run out of people to hire? If you do listen to the business community with Powell, all they do is bitch, moan, and cry that they can't find cheap labor and they're going to have to pay them a little more. So you pay people more, profit margins go down, wages go up, inflation goes up, prices go up, rates go up. It's a self-fulfilling cycle. Okay, let's just look at some times in history where inflation did ruin the party, because it's, you know, this is going so back far in time that most of us just think this is the new normal. Stocks will always keep going back up. So we're going to start off with World War I. And I want you to note on the left column, really bad inflation from 1916 through 1921. We started off with massive inflation and then massive deflation. By the 20s, the war was over and we had the roaring 20s. So during this period, what happened, the big picture is America stole everybody's gold and saved World War I, became the richest country on the planet by far. And meanwhile, all of Europe was a total nightmare. All they could fixate themselves on was trying to get reparations from Germany. And Germany was broke. They couldn't afford to even keep their own economy going, much less pay back everybody they'd done harm to. And so Germany's currency went into hyperinflation. They did all sorts of crazy stuff. They invented new currencies. They were changing who their central bankers were. It was a mess. Eventually, the reparations caused Europe to go into a depression and even America. And so during the 20s, we had a ton of malinvestment. Stocks went straight up. And by 1930, we get a big crash and deflation. So let's take a look at the chart. So you can see during the war period, when we had inflation, stock market tanked. Then we get to the 1920s, we get control of price, and we have a great stock market from 1,000 on the Dow up to 5,500. And then the slowdown in Germany and Europe made its way to the US. And what do we get? The worst crash in the Dow of all time, 5,500 down to, I think it went to low as 250. Frightening. Okay, the next period I like to look at is the Cold War, 47 to 91. Note the inflation for most of the 40s and 50s was completely under control, around 1%. And again, why does the Fed want inflation? Well, if you think that prices will go up slowly over time, you'll go ahead and make that purchase today because you're going to get a better price today than you will next year. But if you think prices are going to go down, you're going to hold on. you're not going to spend your money. So the economy grinds to a halt. So trying to control this inflation is the game of the central banker to keep the economy rolling along at the right speed. The second prices go too hot or too low, we see massive distortions in financial markets. So you can see we had this all under control. After getting out of World War II, the world went on a money spending spree. This is when Japan took off. They were the hottest thing all the way up to 1990. Their stock market flew high. Their real estate, it never went down. Oh boy, they were the best thing under the sun. But eventually inflation came and hit them too. We're just looking at the US markets today. But note what happened in 1965, the end of low inflation and the start of runaway inflation all the way into the 80s. So you can see over here, 3%, 4%, 5%, 3%. It's too much inflation. So what happened during the period of low inflation? Stocks went from 2,000 up to 7,500 on the Dow. Yeah, you have your little mini cycles, but who cares? You could have bought and held and made out like a bandit, never paid your taxes. Great job. Same thing that people are feeling today. But what happened by 1965? Rates were near zero, as you're about to see. And they had bounced it up and down with what used to be considered zero, at least in those times. And inflation was now working its way in. America, everybody had just blown so much money, printed so much money. They were totally reckless. Malinvestment never ends pretty. So we can see very similar to what we just went through. So think about this as perhaps let's let that pop down. Well, so we're looking at the federal funds rate. Look at the 1955, 1960 date. You could relate that to perhaps maybe the housing crisis or the dot-com bubble, and then the follow-up bubble in America. So we were bouncing rates cheap, but we couldn't get interest rates up without causing a crash. So interest rates back then, that was the same as zero. The idea of free money was just unheard of. In fact, if you go back a previous century, the favorite game of countries were currency wars. You go to your border competitive country, deposit all the money you can into that country with all your buddies, and then let them go loan that money out, and then go demand that you can get all your gold out at once. And so they were creating bank runs on one another, and the gold standard certainly had its problem. The world was growing at a faster pace than we could find gold, causing all kinds of currency issues. But anyways, during this period, we did something exactly like we're doing right now, and then that was the end. Inflation started ripping its way through, and you can see what happened next. We had to raise interest rates for the better part of 20 years. So bond market lost money for 20 years. Let's see what happened on the stock market. It was able to keep going up till 1965, and then it crashed for 15 years. Were there some bounces? Sure. But overall, you lost money for 15 years. So if you think you can buy and hold stocks right now, double check this chart a couple times. Does it not look awfully like what we just did with rates? Okay, so what happened after we came into 20% interest rates? All the malinvestment was out of the system. You're not going to borrow money if you have to pay 20% interest unless you have a hell of a business plan. That's for sure. And you're going to probably pay that loan off awfully quickly, aren't you? So it turned into a world where money had to get a lot smarter. Now, this is where Alan Greenspan came in, realized that enough was enough, and he started to lower interest rates. So inflation was under control. He got away with it for 20 years. And what do we have? A massive stock boom. Probably a lot of people on this call today benefited from this, hopefully. And what did interest rates do during that whole period? They went down. Sure, he popped them up a couple times to fight off inflation. Second he did that, you got a mini stock crash. But overall, he pushed rates cheaper and cheaper and formed the most recent big bubble we're living in. But what happens when debt gets to extreme levels? It becomes hypersensitive to inflation and to change of rates. So in 2000 and 2008, you can see a hot inflation print. and voila, you get massive stock crashes. There they are. So if you think you can buy and hold through the next crash, probably not. Ben Bernanke dropped rates 5%, or rather 5.5%. Janet Yellen only had room to do 5.25%. And good old Janet put us at 0% interest for 5 years. More money has flooded into bad investments than ever before in history. And we're now in the biggest bond bubble of all time, $266 trillion in sovereign debt. Now Trump gets elected, everything looks super great. They try their best to hike rates. By the end of 2018, market crashed, bonds crashed, everything crashed. So they went right back to what they love to do, quantitative easing. And now we're sitting on a nice big fat bubble for Powell to potentially pop. And what pressures do we have to expedite this? Well, we got trade wars that will certainly expedite getting to the effective lower bound quicker than normal. All right, guys, that's a wrap for today's presentation. I do want to mention that we have a deal. If you do join our advisory, we're going to throw in a free month in our $10,000 boot camp, which you just got a taste of in today's presentation. So call Dean at 505-322-7515. I'm going to go ahead and unmute everyone and see if we have any questions out there. Now I do see a caller in at 3176. Welcome. If you'd like to say hello, love to hear from you. William, how's it going? Any questions? And Manny, I see your microphone's unmuted. Would love to hear from you. Let me see.
No questions. Good info.
Okay, great. Now, how long have you been following our trades?
Just started.
Just started?
Yeah.
What's your portfolio look like? You all in on stocks? You got some bonds, downside?
Basically just stocks.
Okay. Do you have any kind of downside protection?
No, I'm fairly new at this thing, so just kind of getting educated.
Okay. Now I hear the caller was 3176. Do you want to say hello? Eulette, are you still there? You have any questions? What does your portfolio look like right now? Are you all in on stocks? You got any downside protection? Any bonds?
Oh, I'm just doing paper trading.
Oh, I meant with your real portfolio. Are you invested in the markets?
Yeah, I've got some stocks there that are low, so I should be doing covered calls on them.
Okay. So yeah, so what are you thinking about? If you were to really follow the program, would you be able to follow this trading plan right here? Would you have capital to do that, or?
Yeah, I think so.
Okay. What questions do you have so far? You let any questions?
No.
Pretty clear on the trading plan, when we trade, what we trade, how it all works together?
Mm-hmm.
Okay, great. Jim, you still out there? William, you got any questions? All right, guys. Well, I really appreciate everybody joining us today. If you have any questions, please let me know via email. You could just reply to the trailer and we'll get this replay out later. And again, this is now a daily webinar. So hope to see you guys Monday. Probably the first half will be more unique content each day. And then the second half will be mostly this presentation you just watched. So hopefully everybody had a good time and learned a lot, and we'll see you on Monday. Thank you so much.
Thank you so much for your time.
Thank you. Bye.
Yeah, thanks, Jason.
Thanks, Tom.
Bye.